I think we've made it clear on this show that the Fed basically has just one tool to fight a hot economy and spiking inflation, and that's raising interest rates, and they've been pretty aggressive in doing so. The tightening we've seen from 0% to up to 5.5% has been pretty historic, and the damage to the economy is now just becoming apparent. Just look at today's jobs data. That's a good example. The higher rates go, the more it hurts the consumer and the economy. But what if I told you in real terms we've seen rates rise by almost twice as much? What the Fed's already done, right? We touched on it yesterday with the real interest rate, right? And we took the Fed funds rate and we minus inflation out of that, took back the inflation out. When it was at its peak of, say, 9%, we had the Fed funds around 1% at that time. So we had a real interest rate of a minus 8%. That's pretty easy to get, right? And today, with the inflation rate of around 3.2% and the Fed funds rate at 5.5%, we're just over a real rate of plus 2 and a bit percent. So minus 8% to just over a plus 2%. That's a big move in the real interest rate. That's a real recipe for real pain. Now, my next guest is not a pain. Please welcome to the show, Mike Lee. Mike, thanks for being on. I'm trying to get the point across that there's been a pretty historic shift out there when you talk about real interest rates, not just the nominal interest rate.
Both. Right. It's pretty unbelievable. And you're already starting to see signs of things cracking. If you're not wealthy, this economy is devastating for you right now. So just new car loans. The average new car loan rate is like 9.5%. That's like for people with great credit. What's that going to do to auto sales, right? And then it's just ticking out as the new cars are coming on the lot. And you're not only seeing credit card debt at an all-time high, you are starting to see defaults skyrocket. So, bad things are happening. And I think what not a lot of people are talking about or realize is there's 400 basis points of what the Fed has done isn't even touched the economy yet. That's all within the last 12 months. You have a 12 to 18 month lag, sometimes longer. I don't know how possibly the Fed could raise again, but they might. And this is what happens when you play politics and you're so late to the game, things get so far out of control, you got to overreact the other way. And Powell said he's happy to do that. If I need to choose between higher or not raising enough or over raising so that we kill inflation, he has said time and again it's the latter.
Yeah. So after today's jobs number and a lot of the recent details we've gotten about the economy, where do you stand on where things are going from here? Because I don't have a good feeling, Mike. I just don't.
So, look, I don't know how we don't end up in a recession. And by a lot of different metrics, gross domestic income, we are in one. I'd say I don't want to fearmonger, right? There's no real estate bubble out there the way there was in 2008, where, you come to find out that a waitress owns 6 condos in Florida, right? When she put 2.5% down in each one of them, didn't have to provide any documentation. There isn't that sort of excess in the economy, but that doesn't mean this isn't going to hurt. And what ends up happening is it's like the Dutch boy plugging the dam with his fingers, that once he kind of runs out of fingers, everything opens up, and you're typically only a few months away from when that unemployment is at its lowest rate to when that recession starts. So I'd expect a lot of things to start unwinding rapidly. And I mean, look, you've had leading economic indicators going in the wrong direction for 15 straight months.
Right. And then I've been saying that, and a lot of folks have been discounting what I've had to say. And there's a lot, you've heard them, there's a lot of folks out there that say that, hey, the Fed's actually been able to orchestrate a soft landing. I mean, I just don't see it. And I've said for a while now, it's not going to be soft or hard, it's going to be a long landing. The Fed's come out and said maybe higher for longer, or maybe just high for longer. They might not raise them again. But none of that, to me, says soft landing.
Well, the no landing camp and the soft landing camp are now fighting for the consensus. And everyone, whereas, 6 months ago, everyone thought we would be in a recession, it's now moved now, so that was wrong, right? Now everyone has moved to this soft landing camp or no landing, I was part of that consensus that was wrong. But typically, when you have a broad consensus like this, it's usually wrong. And so things are going to slowly continue to deteriorate. And like you look in this jobs number, like the number of part-time jobs added versus the number of full-time jobs lost, the number of people holding two jobs were approaching all-time highs. This is not a good economy. It is shaky. It is built on credit card debt. The savings rate has evaporated. And if you start seeing a correction in the market with some of these mega cap tech names that are trading at pretty lofty valuations, all of a sudden, you have that wealth effect kick in. And so if people are tapped out now, what are they going to do when their 401k is down 10 or 15%? They're just going to tighten up more. So I don't see a booming economy, right? Like you need to have some sort of recession with a default cycle and bankruptcies so you can clean out all the excrement and rebuild.
I agree. Thank you very much. That's awesome. We're on the same page. Thank you very much. Mike Lee coming to us from Sarasota, Florida. Thank you very much, Mike. Have a great weekend. All right, bye now.